We give this question on consolidation. It says on 1st of October 2014, Prodigal purchased 75% of equity shares in Sentinel. The acquisition was through a share exchange. The stock market price of Prodigal's share on 1st of October was $4 per share. The summarized P&L and other comprehensive income of the two companies are given as under. Now, the key is that we need to first of all always take care of the dates. 1st of October 14, the acquisition was done, and on 31st of March is the reporting date, which means that the acquisition was done 6 months ago. We're given the P&L, etc. What is crucial is to look at the information. It says that Prodigal's policy is to revalue the group's land to market value at each of the accounting period. Prior to its acquisition, Sentinel's land had been valued at historical cost. During the post-acquisition period, Sentinel's land had increased in value by 1 million. It has recognized the revaluation within its own financial statement. So basically, this 1000 reflects the increase in the revaluation, or let's say a revaluation gain in the books of Sentinel, and that is in lines with the group's accounting policy. Secondly, immediately after the acquisition of Sentinel on 1st of October 14, Prodigal transferred an item with a carrying value of 4 and an agreed value of 5. Now this means that there is a profit in the books of Prodigal of 1 million, which is not the profit of the group, right? And for 6 months since the date of acquisition until the reporting date, Sentinel must have been charging the depreciation on this 5 million, but from a group's viewpoint, he should have charged it at 4 million. So we need to obviously consider those things. Third is, after the acquisition, Sentinel sold goods to Prodigal for 40 million. The goods had a cost of 30. 12 million of the goods sold remains in the Prodigal's closing inventory, which is an unrealized profit adjustment. We need to take care of that. Finally, NCI is taken at a fair value, which is at 100 million. There's no impairment loss. So the way we want to kind of move on with this, very straightforward, is to look at the working one, which is relationship between companies, which is acquisition date, reporting date, and percentage. Acquisition date is given as 1st of October 14. Reporting date is given as 31st of March 15. And percentage holding is 75%. Right. Now, I might want to calculate separately the unrealized profit on inventory. So basically, we can use that item first. It's point number 3 precisely. The cost was 30, sold for 40, and 12 million worth is still remaining in the inventory, which means that the profit element is 10 into 12 by 40, right? This is basically the unrealized profit, which is 3 is the profit element which is lying in this inventory of Prodigal. So which means that the profits of Sentinel are higher by 3 million, which needs to be adjusted from the cost of sales. Likewise, we are looking at point number 2. It says Prodigal transferred an item of plant with a carrying amount of 4 million. So I might want to also consider the unrealized profit on sale of plant, which is basically on the sale it is 5 minus 4 is equal to 1 million, and excess depreciation in the books of Sentinel. The life of the asset is 2.5 years. 6 months have gone by. So basically, it's going to be, we need to calculate this as 3000 basically, so because you're taking all the values in thousands of dollars. So this is basically becoming 1,000, and the excess depreciation is going to be 1,000 into 6, that is 6 by 12 into 1 by 2.5. It could have been also done like let's say 1 by 5, so it's just one of the same thing. We take the 6 months depreciation against the life of 2.5 years. That is going to be 200. So these are the important calculations that we've got. What is critical here is to see that the date when we let's say merge these two accounts or consolidate the accounts, we should get a value of like this. So consolidated SOCI for the year ended 1st of March 15. Revenue, there's a sale because happening between the two companies for 40, which means that total revenue should be taken as 450 plus 240 divided by 2, because we're talking about 6 months sales, minus 40,000 will come, which gives me a value of, let's say, 530,000. Likewise, cost of sales, we are given the value is 260 plus 110 divided by 2 minus 40,000 plus that unrealized profit of 3,000 it was, right? There we go. This value is coming at 278,000. But there's one more thing, which is basically this profit has been added. The 1 million has been added or reversed from the depreciation cost, and all depreciation is charged to the cost of sales, which means that the unrealized profit on the sale of plant, subject to reversal of depreciation, again on the sale of plant also it's required to be adjusted. So that is going to be 278,800. That results into a gross profit of, let's say, 2512. The key is that if there is nothing specifically mentioned in the question, we can still exclude the depreciation calculations, unrealized profit calculations from the cost of sales and show it separately. But normally we expect our examiner to be giving this information as a part of this cost of sales adjustment. So it can be worthy to create a separate working for the cost of sales also, right? Next point is distribution cost, which is 23,600 plus 12,000 divided by 2, which is 29600. Administrative expenses, which is 27,000 plus 23,000 divided by 2, that makes it 38,500. Finance cost is also calculated the same way. There is no adjustment for any numbers, so it is 1200 by 2. So we need to calculate these and show these separately as a part of the solution. That results into a profit before tax of 181000, and my tax expenses are quite straightforward on this. Same calculation as before, which is 48,000 plus 27,800 divided by 2, which makes it 61900, and the profit for the year will be the difference between two values, which is 119,100. The key is that I need to calculate parent's share, which is normally the balancing figure, and I would rather want to use, first of all, NCI's share. That needs to be calculated from this amount, which is 66,000, subject to changes, which is 66,000 for the half year, right? Now we remember that there was a sale made by the subsidiary to the parent company, right? So basically what we need to understand is there's an unrealized profit on the sale of inventory in the books of Sentinel, which was 3,000. That needs to be, of course, adjusted, and that is where you would look at the the role of, let's say, the NCI share coming in, right? Now that's one point. So basically what we are looking at is NCI share, which is 25% of this value. Now this comes at 33,000 minus 3,000, which is going to be 7,500. So this is the balancing figure, of course, which is 1191,000 7,500, right? About the other part, which is the other comprehensive income, we have gain on revaluation of land. Now this 1,000 is specifically arising at the year end, and this loss of 400 is arising at the, or maybe over the period of time. So what we need to do is just distribute it in the right manner. So we are looking at it. The gain on revaluation of land is which is 2,500 plus 1,000, because everything is post acquisition. This gives us 3,500, and loss on equity investments. Now this is for 700 plus 400 divided by 2, that makes it minus 900, which gives me total comprehensive income as sum total of this plus 119,100. Out of this, the parent share and NCI shares need to be calculated. So we can simply use it like this, as above. This is the first one, which is 7,500 plus this is the profit of 1,000, which is arising after the acquisition date. So 25% should go to that, but the 400 is earned over a period of time. So this is the total calculation we are talking about. 1,000 as a gain on revaluation in the books of subsidiary post acquisition, 400 loss, which is arising over the period of the time, which is to be taken 6 months amount, which is 200 prior to the acquisition and 200 post acquisition. So effectively we are talking about 7,500 plus 800 into 25%, which is 7,700, which means that the parent shares 114,000. So this covers our first part, which is the consolidated statement of profit and loss account. Second part says prepare the equity section of the consolidated statement of financial position. What we need to remind ourselves is, when we look at this question here, is we are given this information for the equity for the parent and the subsidiary already, right? Which means that this information, that is statement of equity for the year, to be seen from the parents and NCI's viewpoint. That's what we need to take care of, right? So what we can do is we can simply use the same amount, equity share capital, or the share same format, share premium, valuation reserve, other equity reserve, and retained earnings. We've got the amount, and we need to identify how much pertains to the parent and how much pertains to the NCI. Now, this equity share capital is basically to be seen as the value of NCI specifically. So while we do that, we are given on 1st of April 14, before the share exchange took place, that is 250,000. Starting with the parent side. Now this, if you agree with me, that is 250 plus there are shares issued by the parent company in the subsidiary, which is 75% shares purchased, and 2 shares in prodigal are issued for every 3 shares. What is important to us? To identify how many shares exist, which is 160, which means that on 160,000 shares, 75% is acquired, and for every 3, 2 shares are issued. This gives me a total value of 250 plus 160 into 75 into 2 by 3, which is total 330, which means that 80,000 new shares are issued. It's also given that the value of share is given as 4 per share, which means that if the face value is $1, so the premium will also increase for those 80,000 shares. It can be calculated as 100,000 plus 160 into 75% into 2 by 3 into 3. That makes it 100,000 plus approximately or precisely 240,000, which is 340 now. Revaluation reserve, we are given the values. 8,400 is the opening balance. There's an increase of 2,500, and there is a 75% increase out of 1,000, which means that I'm looking at 8,400 plus 2,500, which is the parent's own revaluation reserve, plus 75% of this value, which comes at 11650. Likewise, other equity reserves can also be calculated. 3,200 is the opening balance minus 700 minus 400 into 6 by 12 into 75%. So if you look at this, we have just already calculated all these things. So 2,200, 3,200 minus 700 minus 400 by 2 into 0.75, which gives me 2,350. And finally, retained earnings can simply be picked from above value, which is 11600 plus the opening balance, which is 90,000 for the parent. Which means that I'm looking at a total retained earnings for the parent as this amount, which is a total equity amounting to this. On the NCI, what we need to do is basically look at my opening NCI, which is on the acquisition date, has been stated at 100 million. So I can simply pick it up plus share of profits. It could be in form of equity reserves and retained earnings also. So we can take the NCIs separately also. So I can just use it like this: the non-controlling interest, its share in both realized and unrealized profits, which is already given the value of 7,700. So we can just pick it like this: 7,700, and thus it is shown at 107777. Right? So that's the way we would want to present this information as far as the statement of changes in equity, or let's say statement of equity from the parents and the NCA's viewpoint is concerned. Right? Great. Thank you.